Welcome, everyone. Welcome, welcome. I am not sure if I'm excited or concerned with what I'm about to share, but what we're going to talk about is I'm going to talk about my belief with one of the forks in the road. And what I'll also do is I'm going to go down exactly what to do in each of the forks in the road. And obviously, it all has to do with your money. So let's go ahead and start with my belief. My belief is we are going to see this sort of cataclysm over the next 4 to 5 years. And I don't mean in terms of the market crashing. What my expectation is I think we are going to see a lot of volatility and a lot of concerns, and in my opinion, a whole lot of nothing for the next 4 to 5 years. In other words, let me just graphically depict this. I wasn't planning on doing this. I would have pulled this out, I guess, a little earlier. My expectation is for the next 4 to 5 years, honestly, we're just going to see this. It all started last summer, the beginning of 2018, where the real estate market fell pretty substantially. And since then, we've been seeing this. My expectation, mostly because of what we talked about in yesterday's live stream, we have the Eurozone, we have China, we have a whole global economy that's struggling to get out of the 2008 recession anyway, that my expectation is we're going to see this for at least 4 years. I personally, and this is sort of the direction that I take, and we're going to talk about both forks here, so you don't have to agree with me. It's okay. I want everybody to have perspective and different opinions. My expectation is that we're not going to see a precipitous decline anytime soon. I do though believe that we're going to go into one of the most volatile markets that we've had for probably the last 10 years. I think we're going to have a lot more of this, where the last, since the recession, we've been pretty pampered, since our last recession, we've had a lot of this. We had some hiccups in 2013, hiccup in 2015, and we've had a lot of that. But my expectation is really now we're going to see that. And it's going to be messy. And what's going to happen is it's going to be extremely frustrating for a lot of people. It's going to be very, very difficult for people to understand what's going on. It is going to be a roller coaster. It is going to be frustrating. And there are really two big things that are going to happen. Rich people who are on the right fork, the correct path, are going to get substantially wealthier. Poor people who get onto the fork that ends up being correct will get substantially wealthy and they will no longer be poor. And then there are going to be the people that go on the other fork and they're going to lose a lot of money. They're going to lose a lot of potential gains. And, they might lose a lot of money is the big bottom line. Now, I personally obviously have a bias in my opinion because I believe in a certain fork. But no matter what fork you land on, you're either going to get screwed or you're going to do well. Now, I'm going to give you some reasons why I think my fork, the one that I believe in, is going to be the better one. But ultimately, what I want you to know and what I want you to take away from this is buckle up. You're going on a roller coaster, but you need to pick which roller coaster you want to go on. That is, the whole theme park is going to be going up and down. And you got to pick which ride you're on, so to speak, okay? Are you on Harry Potter or are you on Dr. Seuss, okay? So by saying you need to decide, I think I want to make very clear that, in my opinion, in uncertain times like this, the worst thing you can do is sit on the fence and do nothing. That is, when you sit on the fence, in my opinion, and do absolutely nothing, what happens is you end up suffering. You save money, you leave money sitting in high yield savings accounts thinking you're doing the right thing, you suffer from inaction, and ultimately you're probably not really going to get anywhere. In my opinion, this is the time to decide. And this will be a defining moment because I think for the next 4 to 10 years, the decision that you make this year will define the rest of your life. And I know that sounds like one of those corny, like cliche quotes where it's like, what you do now defines, right? This is the first day of the rest of your life. That's the one I'm thinking of. But I really do believe the decisions you start making today are going to determine how successful you are money-wise over the next decades. And so let's talk about the forks a little bit. Let's bring back out and we're going to talk about crypto too, so stay tuned. But let's talk a little bit about the two forks that are sort of my expectations. So let's see what we have here. Okay. So my expectations are, well, first of all, that you will ideally choose a fork. So the one that we have right here is, I'm going to call it the Nobi fork, not to be confused with newbie fork. And then there's the B fork. And what I mean by this is you either have a belief in the United States economy or you don't. That is a very, in my opinion, oversimplified way of saying this, but I also think it's a very important one. It's one that I think is very, very valid. So the belief here is that if you don't have a belief in the United States economy, if you personally think fiat currency, paper money is going away, and we're going to go in a direction of cryptocurrencies, deregulated currencies, that governments will fall because of this, that the United States economy is going to suffer from the worst possible recession in the history of mankind, then you should go down the no belief fork. And if you believe in this no belief fork, in my opinion, what you should do is you should invest in gold, and I don't believe this as much, but possibly cryptocurrencies. I'm not a big fan of either of these, but I'll tell you, if I personally believed the United States economy was going to crash and that fiat currencies were going to go away, the United States dollar was going to go away, that this trade war, that the elections, that this is going to be the worst crash we've seen forever, I would go in the direction of parking my money into the safest possible assets. Now, I do personally also believe that in the no belief direction, I believe while I just mentioned gold and crypto, I'm also going to throw in there real estate. The reason I put real estate in here is because, in my opinion, real estate has value no matter what it's denominated in. See, there's a lot of belief that, okay, what's going to happen is real estate prices, will fall in terms of the value of the dollar or whatever. Well, fine, if that happens, whatever. But my expectation is if fiat currency goes away, the United States dollar goes away, there's a massive market crash and this big cataclysm happens, real estate will still have value in terms of gold or cryptocurrencies, whatever it is you believe in. So this is the sort of, I'm going to go ahead and I don't like doing this, but I'm going to go ahead and do it because I know people are going to ask, and then we'll answer comments here shortly. But I'm going to go ahead and suggest that this has possibly a 20% likelihood. That is this total collapse, this redenominating assets in different gold or crypto or whatever. I think this is going to be bad for companies and stocks, although companies as well will hold value, except translating those in stocks will be a disaster, I think. Personally, and these are my percentages, right? I'm pulling these out of thin air, but this is my belief. And this is the reason I'm hanging my hat on the belief fork. And again, the worst place for you to be is in purgatory. You don't want to be sitting going, oh, what do I think? Do I think the market's going to crash or is the market not going to crash? My expectation is that there's a greater chance that we're going to see a volatile market for the next 4 or 5 years. But that belief is backed up by the thought that, first of all, I'm having trouble seeing extremely rough data in the marketplace, and I'm going to pull up data right now. And second of all, I personally, and this is the simplest way I could put it, I personally strongly believe in the United States economy. I believe there is going to be a substantial slowing, but I will not give up on America. And I'm not trying to say that to be like some social justice person or whatever. I'm trying to say that because it's what I believe. I strongly believe in America. I believe in the American consumer, which is 70% of the United States economy. I believe that we're going to see a lot of drama with the Federal Reserve. I do believe we're going to see multiple more rate reductions, which they should have never raised rates as high as they had. But let's go ahead now and jump into some of these charts that I thought were personally very interesting. And hopefully you think the same. And then we'll jump into some of your comments as well. So here we go. First thing we're going to do is we're going to share the screen here. There we go. Okay, let's go ahead and let's use this one for a second. Okay, great. So delinquency rates on single family homes. Let's talk about this. Delinquency rates are very important to track, in my opinion. I think the most important thing that signals the possibility of a recession are delinquencies, because that, in order for defaults to extrapolate, in order for the market to get really bad, I personally believe you need to see more delinquencies. So let's go ahead and show this so you can actually see it a little bit better there. There you go. Okay, perfect. So notice what we had here. Notice how fast delinquencies go nuts. This is, in my opinion, scary. It's scary how quickly the market can shift. I mean, look at this. This is 1 year right here. From quarter one 2006 to quarter one 2007. I don't think this lines up as perfectly, but I looked at it earlier. From quarter one 2006 to quarter one 2007, we had a massive jump in single family delinquencies. And I think what's important to also do is look at what's happening now. We're not yet seeing that jump. That's one of the reasons I say I'm not, so anxious as maybe we might otherwise be. I mean, if this were jumping, I'd be more concerned. And I want to be completely transparent with you. So this is where you could see it's actually quarter two of 2006. And then you go over here, okay, quarter one. So quarter two would be somewhere around there. So anyway, you could see that in the matter of even 3 quarters, there was a massive increase. So this can shift very quickly. The market can punish you fast. Here's something else that I really liked looking at was delinquencies on, and let me pull this up for a second. Let me pull up the chat. Another thing that I really liked as well was keeping an eye on delinquencies of credit cards. So this is delinquency rates on credit cards. Or these are. And notice something very interesting here. First of all, notice how much lower in general delinquency rates on credit cards are compared to what they used to be. Credit card delinquency rates used to be between 4 to 5%. And then during the recession, they skyrocketed from 5% all the way up to 7%. Right now, we're sitting around 2.5%. However, we've started seeing an increase in credit card delinquencies. I personally don't like that. This makes me nervous. This is something I want to keep an eye on. If this were still declining, if this chart were still going down like this, I personally would be much more inclined to say there's even a smaller chance of this sort of fork happening, or the negative side of that fork. Now, let's see. This is quarter one. Okay, this is a little bit more research that I've done. So then we've got, what do we got here? Delinquency rate on single family mortgages. We already looked at that. So this was interesting as well. Real wage growth is slower than inflation right now. In my opinion, that's bad. I don't like seeing real wage growth, that is how much money people are actually earning, being slower than inflation. However, the stat that I actually like to look at, and this is extremely important in my opinion, is look at this. Look at the title of this. Household debt payments as a percentage of their income. That is, in order for a recession to really go nuts here, we need people to fall behind on their payments. We need people to stop paying their credit cards. We need people to stop paying their student loans, which are at all-time highs, and we need people to stop paying their home loans. However, when I look at household debt service payments, that is the amount of money they're spending every single month to service their houses, their credit cards, their car loans, their student loans, look at historically what we've got going on here. We've got before the, or right now, over the last, 30 years, we are at the lowest point. That is the percentage of people's income going towards their debt is around 10% right now. In the 80s, that percentage was between 11 to 12%. During leading up to the 2008 recession, that was between 12 to 12.5 to up to 13%. Now, I know that seems small. It's just sort of this 1% difference. But look at how it actually changes when a recession happens. When a recession happens, all of a sudden, people got rid of a lot of debt. And the levels of debt that we have now relative to at the bottom of the last recession are equal. If I start seeing this go up again, like what we saw in 84, what we saw in 94, what we saw in 2000, the jump that we saw in 2006, where income is not going up as fast as people's debt is going up, that's, in my opinion, where the problem is. A lot of people go, oh, well, Kevin, wages aren't keeping a pace with inflation. Right, but we are also not seeing people take on a higher percentage of debt. So in my opinion, that's less of an interest. Now we're going to go to, live chat questions here in just a second. But to me, I wanted to give you this sort of data. I don't want to just be that person that's like, oh, here's what Kevin believes, and I'm just going to yap to you without giving you kind of a little bit of a background on the data that I believe in. Now, other things that I want to very clearly convey here is no matter what the market does, in my opinion, if you believe in the United States economy, you should recall what I talked about in a different, I don't know if you all saw this. I'm just going to talk about it really quickly. There was this really amazing infographic on Reddit. And it was basically, I'll just share it with you here. Take a look at this. You have Tiffany, Brittany, and Sarah. They each invest money into an index fund over 40 years. And Tiffany wants to invest, but she ends up investing at the top of each market. Then you have Brittany, who buys at the bottom of the market each time. And the whole moral of the entire story is that despite Tiffany buying at the worst times of the market, Brittany buying at the best times of the market, the person who actually ends up with the most money is the person who didn't give an F and just kept buying good deals in the marketplace. In this case, that happened to be the S&P 500. In my opinion, the easiest way to insulate yourself, and shocker, you've probably heard this all before, is buying wedge deals in real estate. Why? Because if no matter what the market's doing, you're constantly buying below it. Not only are you insulating yourself, but you're taking exactly what happened here and you're making the best of it. Because look, the chart that we just saw with Sally constantly buying was the S&P 500 doing this. And she didn't care. Over the long run, she just kept buying. Except, in my opinion, when you're buying wedge deals, what are you actually doing? You're actually not buying, along the chart. You're actually making your own chart and you're buying wedge deals below the market by a certain percentage. And that's what we consider the wedge, right? Buying real estate below market value. That to me is what insulates you and what protects you in the long run. That's the reason why I strongly, first of all, I believe in the United States economy. And so if I already know that I believe in the United States economy, I know I'm not going down the dark fork. And so then I look, okay, well, if I believe in the US economy, I know I want to keep buying deals. What's the best way to do it? Well, if I could buy things below market value, I don't give an F what the market's doing. Now, what I will say is there are going to be a lot of opportunities. And watch the live stream from yesterday because I talked about this a lot. But, if you continue to buy below market value, in turbulent times, you're actually able to negotiate better. Why? Look, on a day like this, when the Dow Jones is doing this, how easy do you think it is for me to call up a seller and go, here's my lowball offer. Think about it. You know what I mean? Like when the market's doing this, people lose their crap. Very, very few people will log into their Robinhood or TD Ameritrade accounts or whatever and start buying stocks. After this live stream, I might go buy some stocks. Now, I usually like to dump my money into real estate, but I do keep exposure to stocks. My favorites right now, I know Target's down like 3.5%. Tesla's down like 6.5%. Tesla will be very volatile in the time coming. I'm surprised Target's as volatile as it is. Starbucks only down like 1.5%. Redfin's down like 4%. But that's why Redfin being down 4%, I told you to short Redfin. Or I just put that in the coupon code for the real estate investing course, right? Short Redfin for 20% off. Oh, come on, you guys gotta love this stuff. Anyway, Jacob, why are you spamming, bro? Okay, so let's do a few. Hold on, let me just block Jacob really quick, and then there we go. Let's go ahead and look at a few questions that came up on the channel, and then we're gonna open it up to dialogue here. So there were a few comments that came up in the on the channel, and these are very important because they're gonna give you some more insights into what to do in terms of what to do in this wedge. So this is very, very important. And I purposely chose these comments. So watch this. Let's go ahead and share these here. The first question we have is, don't buy for 15 years. Does that mean we won't see prices again for 15 years? It sounds like we're at a peak. Is this a bad time to buy real estate? Alan, I think misconstrued a little bit of what I was saying. What I said in yesterday's live stream was that if you're going to believe in the marketplace for the long run, for at least the next 15 years, you should not worry about all of this volatility. Instead, take the volatility and use it towards your advantage. Take these Dow Jones charts and on red days, negotiate like the way I told you to negotiate in yesterday's video. So I personally, I get this a lot. People like to say, oh, well, Kevin, the real estate market is the most expensive it's ever been. No, duh. Like that's how the freaking economy is supposed to work. It would be bad if, look, watch this, okay? Let's say we have a peak real estate market in 88, right? And then the market falls. And then we have a peak real estate market in 05, and then the market falls. And then we have a peak in, I don't know, 2024, right? Let's just make it up, whatever. Obviously, if the peaks were lower than the others, that would mean the market. Let me switch cameras here. If the peaks were lower than each other, like if the global economy or whatever country you're in were doing this in terms of the peaks, that would be terrible. So anytime somebody says to me like, "Oh well, Kevin, we're at all-time highs," no shit. Like, that's what I want. That reiterates my belief as to what the markets should do. They should average out always at all-time highs. It should always be doing this. In between, you get this, and then when you look really close, you get this kind of stuff. So, I think that's important perspective to keep in mind, especially because people say these things and they're really impactful with what we think about. So anyway, this guy's back. Oh, that's hilarious. Okay, sorry, I'm getting distracted here. Let's keep going here. So, what will happen to mortgage rates if the yield curve inverts? So, look, mortgage rates right now, if you're thinking about getting a loan, I personally would not recommend paying any points because I think the trajectory for rates is going to be very similar to what we're seeing in Europe. Congrats, Keltran, about to close on a home. I'm happy for you. Good for you. Okay, so I personally believe don't pay points. I think what you really want to do right now, and we talk about in the real estate investing course how to analyze which particular interest rate to choose because it's overwhelming, it's complicated, and I give you a very simple formula and spreadsheet to handle that. And you can always ask me in the private live streams as well. But, right now, I think we're going to be in obviously a trending downwards interest rate environment, which is great because if we're going to be in a volatile marketplace and you can keep your interest rate low, but rents stay stable, real estate landowners are going to be the ones able to profit very well from this. So, and personally, and I'm reading this here, but personally, I don't believe that the election cycle has very much of an impact on the marketplace. What does have an impact on the marketplace is what happens after an election. Look, the bottom line is when Trump got in and he pushed the TTP, the Trump tax plan, real estate tanked because the Trump tax plan disincentivized people from buying real estate. And then at the same time, interest rates went up because business spending shot through the freaking roof, which made the Fed go into overdrive thinking we were about to go into a bubble, and they overcorrected. So, okay, anyway. Then we've got this comment here. What is this comment? Love all you do, Tommy Tom. Thank you. One thing, top 3 or something times of the market you should not buy real estate. Right. So in my opinion, there's no top 3. There's a top 1. The time you should not buy real estate is when the market is guaranteed free falling. And when is that? That would be 2006, 2007, and here's one. Summer, so I'll put S, of 2018. The summer of 2018 was a crappy time to buy. And guess what I was doing? I was on this YouTube channel telling you not to buy. This is why you got to subscribe to me, Kevin. Okay, folks? Only like 30% of you all subscribe. Yet you watch the stuff, which is fine. I still love you. But anyway, so summer of 2018 was a bad time to buy. So when the market is in a free fall and you can't determine, you see how I actually like perfectly faded this out. But when you don't know what's going where the bottom is, don't buy. That is the time not to buy. But right now, we're not seeing that. If anything, we're seeing the real estate market again. It's doing this. And it's teetering with sort of maybe this trajectory of like 1-2% growth, which is low. I mean, obviously, you could leverage that up. You could get good deals. There are ways to increase your returns in real estate. I get all these comments all the time like, well, stocks average better returns than real estate. In my opinion, they don't. In my opinion, stocks and real estate average relatively similar returns if you know what you're doing. But there are a lot of factors that go into it. So anyway, then I got this comment over here, and then we'll jump into some live questions here. But then I got this one. This is, and I remember I handpicked these to help convey important information here. Why would I buy before a recession? And Zach actually had a really good reply here. Buying cash flowing assets, and this is why I tell you folks, I read all the comments, okay? Buying cash flowing assets under market value will always make sense. Waiting for a market crash is what doesn't make sense. Zach, I mean, this was such a beautifully written comment because he's so right. Unless the market is in free fall, it makes sense to continue to buy good deals. Very, very well written comment. Loved it. And then we get stuff like this. I believe the proper slur is everything is a bubble and everything will be beyond bad. I don't know. please, like I've asked this on this channel so many times before. Please send me like data that says, hey, you know what? The market is in a bubble. I'm just not seeing sectors of our economy in a bubble. People are like, well, real estate's at an all-time high. I just explained why real estate's at an all-time high. Well, stocks are at an all-time high. It's the same freaking thing. It doesn't mean it's bubbling. What we started seeing was bubbling at the beginning of 2018 because spending started getting outrageous at the beginning of 2018. Okay, so then somebody wrote, but it can take 18 to 22 months before a recession can hit after yields invert. Yes, this is true. And yes, foreclosure rates at an all-time low. And now something else that I just want to convey here. The yield curve inverting, which we talked about yesterday, what you should do if the yield curve inverts. You should absolutely still watch that video. The yield curve inverting, in my opinion, is a very... It's concerning. It's a great way to negotiate. But in my opinion, the yield curve has never inverted in such a low interest rate environment where banks in Europe are paying people to take out loans. So I think we're in this sort of untried, untested waters arena. And that's why I think we're going to see this very volatile economy for the next, realistically, probably at least 4 years, if not 10 years. And I mean, I'm not making this video and then signing out, okay? I mean, I'm gonna keep making videos like every day if I can. but anyway, yeah, like keep these things in mind. Now, it's another good question here. I just see this in the chat. Look, people ask, well, what about the United States debt? We're at an all-time high. And something to know is the United States debt is over 70% owned by the United States consumer. And inflation erodes that debt. And it's really money that we owe to ourselves. So in my opinion, the United States debt, while it can be concerning, is not an indicator of recession or a possible crash. No, this is not a deal analysis live stream. When I do deal analyses, I look at individual properties and pictures, and I help people determine whether or not they should buy deals, which you can join the real estate investing course and take advantage of that as well. Anyway, so folks, my big opinion right now is, and this is what you have to ask yourself. And I know this is asking a lot, but you've really got to ask yourself right now, do I believe in the United States economy? What ship do I want to be on? Look, do you want to go be on a ship in Russia, in China, in Germany, or in the UK where their GDP is negative? Or do you want to be on the United States ship? And if you're on one of the other ships, I'm sorry, like you're on the ride. It is what it is, right? We're all in the same ocean is my point. And do I think the ocean is going to drain and everything's good, our world is going to implode? No. But guess what? Even if the worst case scenario happens and everything goes to crap, I still think I could sell my real estate in Bitcoin or gold any day. I don't think houses are going to like disappear in value no matter what currency they're denominated in. But and if worst case everything goes to crap and I'm wrong, then you know what? Everybody else is probably in a really crappy situation. And if that means I have to go start over and be an electrician because I love doing electrical stuff or find something I love to do and start over, oh well. But the reason I'm saying that is because I believe there's such a small chance of that happening that I'm not going to make investment decisions based on the fact that I think the United States economy is going to fall apart. I don't believe it. I don't see the indicators that we saw prior to the last recession, and I look for them every single day. I'm not going to hold up the book again that I hold up every time I say this, but I strongly believe in the U.S. economy, and I think if you believe in the U.S. economy as well, you should buy undervalued assets and focus on making money, because I don't think if we're going to see a recession, it ain't going to be tomorrow. It ain't going to be in the next year. It's probably going to be something that develops, honestly, over the next 10 years. And that's why I say I think we have a solid 4 years of let's call it developing time or like calibrating time where we're like, whoa, what's going to happen? What's going to happen? What's going to happen? So, yeah, I mean, of course, the yield curve inverted. I mean, we know this. We know this happened. So, folks, yeah, I mean, look, and I know there are a lot of people that say, hey, let's get the market to crash. Hey, Tozy, you got to rewatch this thing, okay? This was a money stream right here. Watch this thing. Will make you money. But look, there are a lot of people most people who believe in that fork in the road that I talked about, most people who believe in the fork that says the market and economy is going to crash are the people who don't have assets. I hate to say it, they don't have assets. They're people who want to get in. They're people who want to make money. We need more Cardone prank videos. Wait for my Vegas announcement. Look, I just don't see the what might cause the next recession yet. And the second I do, I guarantee you, I will break it to you. Look, I'm optimistic for all of you. I encourage you all to be here. Let's see. I have 65K in an IRA to reinvest and stuff. One of the things that I would say right now is I personally, in volatile marketplaces, think stocks are fine, but you need to disassociate yourself from this. So if you're going to invest in index funds, you're going to pick stocks, you need to, unless you're a day trader, like disassociate yourself from this. When you see that red right there, this is literally what I want all of you to do. And this will change your life if you do this one thing. Okay, hold on. I'm going to write it right here, okay? Watch this. I haven't done this before. Okay, you take a little like sticky kind of thing. You put it right there. Look at what it says. I don't know that you can see that. It's a sale. It's on sale. Okay, that's what I like. People say things like, Warren Buffett's favorite quote is, be greedy when people are fearful. I think for the next 4 to 10 years, you will literally have this open window that's like people are fearful. There's a lot of fear in the marketplace. Now, a lot of other people will say to me things like, hey, well, Warren Buffett has all this cash. Why isn't he going out and buying stuff? Well, because he has so much money. It's very difficult. There's the law of large numbers. When you have so much money to make investment decisions. Look, if you have $50,000 and you go buy a wedge deal in real estate and you increase your net worth $100,000, you just doubled your money. That's massive. But when you have $100 billion and you go buy a wedge deal in real estate, it doesn't do anything. It ain't worth it. You know what I'm saying? These are important things to consider. Warren Buffett, I love him. I admire him. I recommend all of you read the information that he has. But the bottom line is, when there's so much money to invest, it's very difficult to choose. And this is the kind of marketplace where we should all be kind of looking for those opportunities. And my favorite opportunity, this is not a surprise, is buying below market real estate, because it's one of the easiest places to do that right now. Although, sometimes people come to me and they'll say things like, oh, well, of course, it's just a real estate agent saying buy houses. It's so jaded. It's kind of like people think that I'm going to sell everybody in this live stream a house. Like, oh yeah, please call me up and buy in Ventura, California. I don't know. I just don't see it. Okay. I see the next 4 years as, and this is probably one of the best bottom lines here that I'm going to say. Guaranteed, we are going to see a slowdown, but I wrote this down. The next 2 years, in my opinion, the next 2 years will define the future of your wealth. Are you going to stick to the bear side, or are you going to pick up on opportunities, strike, and believe in the United States economy? And my opinion is you can't go wrong believing in the U.S. economy, because if you get screwed, everybody's getting screwed. If you don't get screwed and you were sitting on the sidelines, then you're screwed by default. And if you jump into the U.S. economy and you believe in it, then I think you'll be doing pretty well in the long run here. Generic quote about watching. What? No, Young, this is a live stream. So folks, that's what I've got for you. I really, really appreciate you all being here. I am personally not a fan of buying precious metals. I'm going to just probably end on that note there. I'm not a fan of buying precious metals. They're not productive assets. You can't do anything with them. Even Warren Buffett says that. Warren Buffett will tell you he doesn't believe in buying precious metals because what his quote is, you could rub them, you could coddle them, but you can't do it. Like you can't rent it out a gold bar. You know what I'm saying? I mean, maybe on like a movie set. I personally don't flip houses. I do think there is money to be made in flipping houses, but I think the selling costs are extremely high. Happy to do questions now if you folks have questions. Where do I find these charts? Folks, the best place, I don't think annuities are good. I think you get screwed in annuities. The best place, in my opinion, to find data is on this website called the St. Louis Federal Reserve. You can Google them. And they actually have an app called Fred. Yeah, it's actually really, really useful, and you folks should all use it as well. This is kind of what the app looks like, and you can really go in there and pick your charts and see what's going on with data. But reading stocks and making prediction or charts and stuff is definitely a difficult thing anyway. So I personally, thank you so much for the donation there. That's awesome. Thank you. So as far as when do I think there's going to be a bottom, I think we're going to have a volatile 10 years. I don't think there's going to be this precipitous decline and then rise again. I think we are really going to see volatile next at least 4 years. And REO negotiating, bro, there are no REOs right now. I showed you the chart. Oh, Sumi, thank you so much for that. Elvis Presley was an electrician. That's amazing. Did not know that. Thank you for that. Oh, what's up, Justin? Thank you for that. Look, I don't think there's going to be a precipitous decline because look at mortgage rate defaults. And then you're asking about real estate owned foreclosures, basically. I don't see more foreclosures coming, at least until defaults go up. For there to be more REO opportunities, we have to see foreclosures go up. We ain't seeing foreclosures go up right now. So let me pull up the chart for you again here because I've got it. And it's important to look at. When this chart changes, be nervous. I promise you, I will freak out on this channel when this chart changes. You could look this up yourself, okay? So that way you could track it, pin it to your wall. The St. Louis Federal Reserve, delinquency rate on single-family residential mortgages, booked in domestic offices, all commercial banks. Great. Okay, look at this. When this chart starts going up like crazy, like it did between 2006 and 2007, look at this. You had your signals. You had your signal starting in 2005. You had your signal that things were going up. Then you had your signal, like in case you didn't get the memo in 2005, in case you didn't get that memo right there. You had another memo right here going, what's up? Hello. And then there you go. Then you get this massive skyrocketing of defaults. But look at the chart where we are right now. It's plummeting. It's plummeting at a faster rate than it was going up in 2005 and 6. Folks, thank you so much for the donations here. C. Smith, thank you so much. You guys, y'all rock. Really appreciate y'all. I'll be in Seattle this weekend, by the way, in case anybody else wants to come. San Francisco, Miami, and Austin, Texas are after that. Obviously, join me in the real estate investing course. That is, you can still use coupon code SHORT Redfin. Every time I do a new coupon, the price goes up a little bit because I have to answer more questions. But anyway, that'll get you 20% off. So anyway, buy puts on Fannie, Freddie. Okay, I would love to see you in Austin. Wells Fargo is having a special event saying they will have $15,000 towards closing and down payment if you apply for a home before September. Why September? It's probably quarter end for them, honestly. I would jump into that. I would take advantage of that. Any kind of deals like that you could get. I just had a phone call with a course member. He got a home equity line of credit that is prime -1. Like the interest rate was like 2.9 or like, I think it was like 3.4% or something like that. That's insane. What about millennials not buying homes? Look, there's not like a precipitous decline in millennials not buying homes. These are, in my opinion, kind of clickbait articles and titles and things like that. But millennials are making up the largest segment of home buyers right now. The overall home ownership rate has kind of slowed. The growth in that rate has slowed a little bit, but I'm not super worried about it. What's my opinion on dividend investing in volatile market? I think it's great. I think it's the dividend investing in volatile market is the same as investing in cash flowing real estate, which I think you guys honestly should all do. I think it's a great time to invest. And I'm going to sign off right now. And guess what I'm going to go do? I'm going to go on TD Ameritrade. I'm going to go buy some stocks. And if you follow me on Instagram, I will post the daily story as to what stock I bought within the next 20 minutes. I will see you there. Thank you so much, everybody. Really appreciate you being here. Love doing live streams with y'all. And until next time.